If you were able to build a system where you had a guaranteed product that's growing and has a death benefit to protect your family, and you could use it to build more wealth, why wouldn't you do it?
It's not this or that, it's this and the return of whatever you invest in. The way to wealth is always to stop focusing on having to work for money and have your money work for you.
If we have long-term thinking, we can build wealth. If we give up a little bit of short-term liquidity, we'll have long-term leverage and control.
Thanks everybody for joining us. It's another week, which means it's another wealth webinar, joined here with Mr. Craig Yenny, Mr. Snaggy. We are going to bring you an amazing show today, an amazing lesson today, all about controlling the bank. And if you control the bank, you control the future, and that is the most important thing. There are three main things you're going to learn today, and I will read them verbatim. You are going to learn how to upgrade how you receive money. Okay, that's number one. You're going to upgrade how you spend money. We're not going to change how you save or how you spend. We are going to change how you receive money. That is a very definitive difference. And we're also going to change how you leverage money. So if you're up to change, today is going to be an amazing one. And let me just start off by telling you the one thing when I first learned about this concept, I was a financial advisor. So most financial advisors, they got a wee little bit of an ego like this. And I had one of those. And I sat down with somebody who I knew was far wealthier than me, multi-generational real estate family. And I was borrowing money from them to do flips. And I remember asking this person how they lent money. I just wanted to learn. And he started to tell me how he lent money. But he said one thing that I'll never forget. He said, I lend from my private banking system. When he said that, I thought he meant he owned a bank, but he didn't. He said, I have a private banking system. He then began to kind of go in through this whole story of this private banking system, but he didn't tell me what it was. He told me why he used it. You see, a lot of people always want to know what. What is it? What? But the thing we should be asking, the change we should make in what we seek is the why. And that's what he began to tell me. He said, this is why. Guaranteed interest, dividends, tax-free environment, got to protect his money against judgments and liens, and got to use his money, spend his money, or lend his money in this case, while still making money on his original principal. So that was what got me, because I never ever in my life had heard of a place where I could put money, earn guaranteed interest plus dividends in a tax-free environment, but then use that money but not affect the compounding nature of how I was earning on that original amount of money. So here's the easiest way for me to put this. Imagine you saved money and you put it into a magic account. And we're just going to call it a magic account because we're going to get right into what this magic account is. But you put it in this magic account where you earned a guaranteed interest rate plus dividends. You were making over 5% on your money tax-free. But then somebody came to you, like with a real estate deal, and said, hey, I got this great opportunity. Would you like to lend money or invest in my deal? And you said, yeah, I'd love to. In most cases, you would take money out of your bank account and you would give it to that person, and then you'd be making money once, which is whatever that opportunity paid you. But imagine now that magic account is holding your money where you're earning, but then you get to use that money, but your money never left. So imagine your money's here earning, you get to use that money, but it never stops earning uninterrupted compounding interest. So how many times are you making money in that equation? You're making money twice on the same dollar. And you didn't change anything, folks. You didn't take on any more risk. You didn't work any harder. You didn't save any more money. You simply changed where the money went first. That is the fundamental thing that we talk about. And that is exactly back to the beginning of what I said. Control the bank and you control your future. Now, Craig put together something amazing, but there's one thing that I really wanted to go into before I get started, and it really comes down to a parable. I'm sure all of you know what bamboo is, right? And I'm sure all of you probably have seen bamboo, fields, jungles, or maybe just a bamboo bush out in your backyard, or bamboo weed, I think is what most people would call it. Do you all understand how bamboo trees grow? Maybe you've heard this before, but a bamboo tree, just so you know, will start growing and you will not see any of the growth for a long period of time. How long of a period of time? Well, about 5 years. So when a bamboo tree starts, okay, it starts growing underground. For a period of 5 years, it grows, and it grows these roots, okay? Its foundation, it plants its roots deep in the soil, and that allows it to take its next phase. Its next phase allows it to shoot out of the ground, and literally in a matter of 1 week, and this is in the Guinness Book of World Records, so I actually had to write this down. In a matter of 1 week, bamboo can grow 3 feet in 1 day. But it took 5 years for that bamboo to instill its roots into the ground to guarantee its success long term. 5 years of nothing from the surface. To the naked eye, to us and animals, we saw nothing. We saw this little sprout that meant nothing. It was smaller than a blade of grass. And then one day, it emerged out of the ground, and in 1 week, it grew 3 feet. Now, the average bamboo tree will grow 3 to 5 feet a year. There is literally, it's not even a joke, but you can watch a bamboo tree grow. Think about that. Bamboo trees get up to be 90 feet high or more. They're rock solid. They grow fast once they come out. But it was that 5 years that you saw nothing that really mattered, because without those 5 years, the bamboo tree wouldn't have been stable enough, wouldn't have been able to support that kind of growth into the future. That is a very important parable. A very important parable. And one that I love because it goes into something that Nelson Nash, the founder of what we know as the infinite banking concept, said. And here's what Nelson Nash said. He said, "Our need for finance over a lifetime is greater than our need for life insurance protection." But what is it that we are told to do? What is it that we have been brought up to do? What was it that I was told to do early on as a financial advisor? I was told to go out and sell a product, life insurance, for protection. But if our need in our lifetime is the greatest for finance, think about that. Financing your home, multiple homes in most cases, all the cars you're ever going to buy. Okay, those are all financed. You're going to finance, rehabs on your house, or you're going to finance new kitchens and bathrooms. You're going to finance everything. Some people finance their groceries. Our need for finance is greater than our need for life insurance. So why are we buying life insurance? Why is it that buy term, invest the difference is one of the most popular strategies out there that Dave Ramsey always talks about? It's because we've been conditioned to believe completely false things. And I guess another reason for it is we've been brought up to believe in just short-term gain. We've been literally brought up to think that we want everything today and we are willing to wait for anything. Well, you really don't have to wait for things. Okay, I've been riding my bike to work a lot. And as I ride my bike to work, a lot of times I'll just grab my phone, and when there's no cars coming, I record myself just saying something that I've learned. And one of the things that I always talk about is, the misnomer that a lot of people can build wealth by saving or spending less money. And I don't really believe in that. The Dave Ramsey model of eat rice and beans and then beans and rice and save money in an envelope. When you follow those kinds of teachings, and for some people, maybe that's appropriate, but for all of you, I can tell you, all 200 of you on here right now, that is probably a terrible piece of advice. Because if all you ever do is save, you will never become wealthy. I'm telling you a fact. You cannot save your way to wealth. Period. You can't. And you can't just scrimp and cut and not drink Starbucks and eat rice and beans and not do the fun things. Because here's what happens. Just this week, several things have happened in my life. Number one, my mom's friend just died today. He had been in the hospital now for 6 months. 6 months. And I can't remember the cause, but it wasn't what the doctors diagnosed him with. He was in a coma for months. He's a young guy. He's in his 40s. I think he's my age, maybe a year older than I am. And he got really sick, got put in the hospital. They induced the coma. He was in the coma for a while. My mom was visiting him. He finally came out of the coma, but he was like green. His skin color was green. And then he was poisoned, but he was poisoned through something. And I can't remember what it was. Not like he wasn't poisoned intentionally. It was just something he ate or something he did. Just yesterday, and we still don't know the facts, he died. They said he fell and hit his head. Was it a massive heart attack? Was it a stroke? The point is, we never know when we're going to go. Okay. Another one of my really good friends is very sick. Okay. And it's happened very fast. I don't know if he's going to make it. I'm rooting for him. I'm praying for him, but I don't know if he's going to make it. But the thing I'm trying to explain and instill in all of you is, if all you ever do is scrimp and cut out the things that make you happy, the things that you love, you are literally, just remember, every day is so precious. You are giving up the things that make your life exciting, that make your life worthwhile. I know we got to give up a little bit to get where we want, but really the way to wealth is not by saving or scrimping. The way to wealth is to learn how others have gotten there and to just follow in their footsteps. And the way to wealth is always to stop focusing on having to work for money and have your money work for you. But to do that, you must pay yourself first. And to do that, you must have a long-term vision, a long-term approach. You must have an imagination. And most importantly, you must believe in yourself. You must believe you can do it, because without that belief, without that worthy idea, you will never get where you want to be. And if you let other people take you down, if you listen to what other people tell you, that you can't do this, you can't do that. Somebody was telling me earlier in the chat that, you know, one of their family members stopped them from moving forward. That's a temporary thing. Listen, the failures in our life, and we could chalk that one up as a failure, right? Like somebody stops you from doing what you want to do because they have a different view, a different opinion. All that is a stepping stone. It does not mean it stops there. It does not define you that that person said no. It does not define you that that person shot down your idea. You know how many times I get shot down, folks? You know how many times people tell me I'm full of shit, that I'm a scam artist? Like just the other day, a huge influencer on a webinar said that what I do is garbage. And I'm just like, that's really funny. I have thousands and thousands of clients, and it works for every single one of them. I don't have people mad at me because this works. But yet one person, just because they have self-interest in mind, and I'm not going to talk about it, decides to say that I suck, okay, in other words. Do I let that define me? No, I let that fuel me. If that person thinks that, how can I overcome that? What is the lesson there, and what is the stepping stone for me to get to the next level? How do I serve more people? How do I solve more problems? Everything I just said is long-term thinking. It is not something I'm going to accomplish tomorrow. It is not something that's going to be finished next week. It's not something that's going to be finished in a month. It is long-term thinking. That's exactly what we are going to talk about today. And Nelson Nash said, you have to think long range. It's a lost art in today's world. Most people don't think, they react. Let me repeat that. Most people don't think, they react. IBC is a process of thinking. It is not a product. We are going to talk about a product today, but I want to be very crystal clear. The infinite banking concept is not a product. It is a system. It is a process. It is a strategy. It is a strategy that will change your future. And we got to use time as the tool, not a crutch. That's Mr. JFK, the late JFK. With that being said, folks, I want to kind of bring Craig into this one, and I want to have Craig kind of lay the foundation of what we're going to go over today. We're going to start with the thing that most people always want to talk about, including that big influencer that I was talking about last night. The only thing he ever wants to talk about is the product, a product. And he talks about a product in a sense that this product's going to change your life. Folks, first and foremost, have any of you ever found any one product that has completely changed your entire life? Anyone? Does anyone have any product that changed your life? There may be one or two, or there might be one rare example. Now, let me ask that question a different way. Have any of you ever used a process or taken advantage of a concept or a strategy that changed your life? The answer is 100% of you. It's not the product that changes your life, it's the process. The product might be a piece of it, but it's the process that at the end of the day that changed your life. That's a fact. So with that being said, let's start with the product. And then we're going to show you how the product just makes the process a wee little bit more efficient than what we've been taught. Craig, take it over.
All right, let's do. And as for those of you that have watched what I do is typically a lot of numbers, we're trying to skim that down a little bit today. So if you have specific questions on how this is going to work for you, we have a team that can get into all those numbers and all the nitty-gritties with you. But today we want to just kind of focus on some of the product, but a lot about the process. And I'm going to also reiterate a couple things that Chris did in his opening. The parable of the bamboo, the long-term thinking, all of these things are going to be the theme and critical as we go through this set of the presentation. So
Lucy said, technological devices changed my life, but definitely see the point. So I was just starting to type this. It's the process on how we use those technological devices that has changed our life. See, it's how you frame it, but literally it was the process of how we use those, not the actual device itself.
Yep, just kind of laughing at Shane's comment. Yes, indeed, I am the clean shaven Craig. So the beard's gone. He'll be back in October. So, I think Steven, when we were on the first meeting the other day, he's like, "Who in the heck is that?"
Yeah, looking good, man. Looking good, Craig. Looking good.
Right, thanks. All right. So today, as Chris kind of talked about already, we're focusing on controlling the banking function in our lives. And by doing that, we're going to be able to control the future. We're going to have more leverage and control over that. But there's a short-term trade-off, and some of that's going to come in the form of liquidity. And so that's what we're going to focus on today. And just to kind of set the table, we're going to be sharing some numbers. We're going to share some examples. All of these numbers are subject to be different for your specific situation, but just know that the process is going to be the same. The numbers may be a little bit different than yours. So what's the theme of today? If you haven't caught on yet, we're giving up something today so we can gain something for tomorrow, or we can gain control tomorrow. And that's really the main thing that we're talking about. In order to really go through this in a methodical way, we broke it down into three kind of chunks. The first one is really recognizing the need. So we can talk about this for hours, but why do we want to have control? Why do we want to have our own financial resilience? Why do we want those things? It could be for legacy. It could be for, just kind of getting out of the banking system and being able to have more freedom with the use of our own money. Anyway, there's a lot of different folks here, probably have different needs, but that's the first thing we want to do is figure out what is your need. And then, as Chris mentioned, we have a tool, and we're not going to be hyper focused on the tool, but the tool is, and it's a long thing to say, so I'll just go ahead and read it out. It's a specially designed and engineered dividend-paying whole life insurance policy from a mutually owned insurance company. What didn't you hear me say in that? Did you hear IUL? Did you hear term insurance? So, this is kind of critical to understand is we use a specific tool to fulfill the role of supporting the needs that you have and building a system around what you're trying to accomplish. Now, when we use the tool, what are some of the things that we're going to be doing inside of that tool? Well, there's uninterrupted compounding. I saw some messages earlier, people were saying uninterrupted compounding. We're going to focus on paying our premiums. We're going to borrow that money. We're going to multiply our value. So in these three steps, we're going to spend the rest of our time today just kind of going through these in a methodical way. So Chris, back to the parable of the bamboo. I just want to draw some correlations between, if you read the parable of the bamboo, it's about a Chinese farmer. And of course, just like some of the folks in your family or maybe your financial advisors, they're going to treat you the same way the neighbors were treating this Chinese farmer. They're looking at this guy going, "Why are you watering the ground? What have you been doing for the last 5 years?" They think he's lost his mind, but yet that farmer had patience, faith, and perseverance that someday he would have this bamboo, tree to grow. So when we look at the comparisons of the bamboo tree, we look at how that relates to the infinite banking concept. In the bamboo cycle, it takes years before there's any sort of visible growth to that plant. How do we correlate that to infinite banking? Well, it takes some time for our policies to become efficient. Are we going to be able to get 100% of every dollar out of that system in the first couple of years? No. So we're giving up a little bit of liquidity. It does require consistent nurturing. And kind of how I look at that in relation to the policies is we want to be disciplined and continue our premium contributions. And so, Chris, we run into folks, from time to time, Stephen, you hear it as well, where people want to come in and maybe put a big dump in, maybe 1 year of premium, and then just not fund this thing anymore. That's not really how it works. We can't just go dump water on the bamboo roots once and have this thing grow. So we want to be disciplined to continue those premium contributions. However, when we get those breakthroughs, and I saw a comment about, does a policy grow like a bamboo? Well, it does have that momentum, but it's not going to grow, 3 feet in a day, like Chris was talking about, but it will grow and it continues to get, it just kind of snowballs down the path of the more mature that policy is, the more it gains. You have this tax favored loans, you have control. So anyway, it's all about the long-term reward for that patience, and that's what we're going to go over is some more of that. But anyway, it's a good analogy. If you just keep that parable of the bamboo in mind as we go through the rest of this, a lot of it will make sense. Chris already shared some of the Nelson Nash quotes. If you haven't read Becoming Your Own Banker by R. Nelson Nash, put that on your reading list. Go through the book. It's a small book. Read it 5 or 6 times. Nelson Nash was big into rethinking your thinking, because I'm just going to pull out a couple things here. And one of the things he said is, if conventional wisdom was right, wouldn't everyone be financially independent? And I just want that one to sink in. So what are some, and I'm going to ask the audience, what are some of the things, and I've listed some of them here, but what are some of the conventional financial wisdom that we're told? What have you been told growing up? What did your parents tell you? What did you hear from others in your circle on how to do finances? Shane says 401k. I mean, that's a big one. You get your first job, you want to sign up for your 401k, you want to max fund that thing, right? Anybody else? Yep, don't spend the money you don't have, which is a good, good approach. Save. Some people didn't hear anything. So growing up, you just kind of got a tap on the back. Good luck, go forth and prosper. So, and I think about all of these different things that we're told growing up, which is 401ks, the BTID that you see here is buy term, invest the difference. Stay in the market for the long haul. Even though the market is crashing, just stay there. You'll be fine. Just keep, pumping your money in there. So those are all the things that we've heard. But then the question is, if all of those things work, wouldn't everybody be in a better financial position? And then the last thing, Chris, in WTF this morning, you were talking about, if you go into a bank and you buy a CD, what are they doing with that money? And you had mentioned a path where a person could skip the bank and get something equivalent to a CD or better. I just thought it might be good to reiterate that, even though it was on WTF, maybe not
It's a
everyone.
different audience. Yeah, I'm happy to. So what I was saying earlier today is, it always surprises me. Like, I know all of you have walked into a bank, and there's usually, at the teller counter, one of those little plastic things, and in there it has the CD rates or maybe the savings account rates, and you're often sitting there. It takes forever to make a deposit at a bank these days. So you look them over, and I remember just glancing over at KeyBank when I was in there the other day, and I saw 6-month CD rate, and if I'm not mistaken, it was 3.82%. So a lot of people, I have to believe, are sitting there. They're looking at their statement. They know they're getting nothing on their checking, maybe less than 1% on their savings, and they look up and they see 3.82% for this 6-month CD, and they're like, well, the money's just going to sit here. I don't have a place for it to go. And they move it into the CD, which gives the bank control of your money for 6 months. But I wonder how many people actually sit there and logically think and say, if the bank is paying me 3.82%, what is the bank doing with this money to make more than 3.82%? So first thing you'd have to understand is the bank is not lending that money, because 6 months isn't long enough for almost every kind of loan. So, right, they can't lend out money for 6 months. So they must be doing something else. Well, I pulled up the bond rates for Treasury bills. Okay, and just this morning, the Treasury bill for 6 months was, I think, just under 4.5%. So the bank's going to give you 3.82. The bank is immediately going to take your money and buy a 6-month Treasury bill from the United States Treasury, okay, from the government. And in 6 months, the bank is going to get given all their money back. But during that period of time, they make let's call it 4.32%. So they make 4.32, you're making 3.82. Do you see what I'm saying? The bank is making the spread risk-free. Why aren't we just bypassing the bank and going out and buying the T-bill? Because if we bought the T-bill, we don't have to play the games with the CD. We don't have to play all the games of, like, if I take the CD money out early, something emergency happens and I need that money, then I got to give up interest. If you bought a T-bill, you're paid the interest, and anytime you want to get rid of it, you just sell it and you get your money back. Just like that. And the bank knows this, but why are we not taught these things? I'll tell you why your advisor's not telling you this. The advisor can't make money on that. That's why you don't hear these things. Nobody has figured out, or there just is no way for somebody to get paid for giving you that advice. So therefore, we just take the path of least resistance, go to the bank, give the bank our money so that they can control our money, use our money, and make more money. And it just sometimes saddens me to think that like this information should be available to everybody, but yet nobody knows this. The advisors are being paid to manage our money, but yet they're not teaching us these things or telling us these things, as if all this knowledge they want to keep because that's their superpower. I was told by a mentor a long time ago, and I'll wrap on this. He said, give your best stuff away for free. Well, I'm not saying that's my best stuff, but that's some pretty good stuff. Always question why. Why is the bank able to pay me 3.8, and what is the bank doing with my money to make more than that? There's your answer.
Yep. So you're starting to think like a banker and just do what the banks do. So
Be the bank.
Yep. And just kind of thinking of a story that I saw that's kind of relevant to this whole conversation is if we go back to that conventional wisdom, and there's something I saw on social media recently where a dad was trying to teach his son, maybe delaying some gratification for something better in the future. So he drops him off at daycare and he says, you can have this gummy bear now, or after daycare, I'll give you 2 gummy bears. He was so proud that his son picked that I'll take the 2 gummy bears afterwards. So he picks his son up after daycare and he's like, where's my gummy bears? And he goes, well, sorry, market volatility, I ate them all. So it's kind of a funny story that, the son was wanting to have a little bit of, maybe delayed gratification for 2 gummy bears later, but then his dad ate them in this market volatility. So that kind of what happened. That's what can happen in real world. So I don't know if he actually did that, but I love the story. But anyway, let's move into case study time. Now, what we typically do is we'll just kind of pick out a person, like you call him Bucky Doe, whoever you want to call him, but what we decided to run with was a 50-year-old male, and assuming that person makes an annual gross salary of 150,000, we're going to kind of build a strategy around that. And then I listed out some of the other ingredients that go into the specially designed whole life policy. Now, as we go through this, you might be a 30-year-old female, you might be a 60-year-old male. This still works. It's just your numbers might be a little bit different. Now, there's a couple things that we rarely talk about that we want to share with you today. And there's 2 things when we're designing policies. One of them is called human life value. And then another thing we want to talk about is the premium to income ratio. Has anyone heard the term human life value? And do you know kind of what that relates to? So I just want to see in the comments, just have you heard of human life value? Do you know what that is? I know some of the folks know, some of them. Linda says how much you're worth. Of course, Drew knows. Well, let's go ahead and define that because it's sometimes part of the ingredients of how we will design this. So let's first take a step and say, what is the perspective of the insurance company when we talk about insurance? And why does income and insurance, how do those things relate to each other? So if I'm the insurance company, I'm looking at an insurance policy as a means to replace an economic loss. So think of car insurance. You're getting your car insured because if you total it or you get in a wreck, then the insurance company is going to compensate you so you can get another vehicle. Life insurance is no different. They're simply saying if something happens to you, you get run over by a bus, you then have an income replacement for your family. So when we talk about human life value, it's defining the economic value of a person's life. And when I share this with people, I always say it isn't putting value of you as a human. It's just simply putting a value on you in terms of your economic value, which is going to be based on your income. That's important because the insurance company is going to figure out what is the maximum amount of insurance that you can have on your body. And we'll talk a little bit about how that works, but I just want you to know the concept and why it's out there. The other thing that insurance companies look at is life insurance is not really there to create windfalls. However, it can create a windfall in terms of the death benefit, but their focus is really to replace the income that your family would not have if something happens to you. And then as we talk about incomes and insurance, the higher your income, the more assets you have, the higher amount that needs to be replaced. So that means you can have higher premiums, you can have a higher death benefit. So those are kind of the borders around how we can build and define what how the insurance policy gets built. So here's a quick example. Let's say that you're 50 years old, you make 150,000 a year. There's a multiplier that goes onto the income. So in this case, if you're 50 years old, you have a 20 times multiplier, which really means the insurance company is saying if you're making 150,000 now, you most likely have about 20 more years of income producing in your life. So let's just take the 20 times the 150 and say you need about $3 million of death benefit if you got hit by a bus today to cover your family's income needs. So that's where the 3 million comes from. Let's say you're 30 years old, there would be a 30 times multiplier. So just take your gross income times 30, that's your human life value. So then the other element that we're going to be looking at is what's called the premium to income ratio. So Chris, can you help me understand, if I'm the insurance company, if I make 150,000, why can't I put 150,000 into an insurance policy?
Why can't you put the 150 in?
Yeah, so if I make 150, why can't I just put it all into the insurance policy as premium?
Because they don't want you to, well, first and foremost, they won't let you because they only want like roughly 30% of your income to be able to be put in. And that's primarily because they know if you put all your money in, you're not going to be able to pay your bills. That's a simple answer. I know that's not the answer you're looking for.
It is actually. I mean, because we get that, right? We have people that want to put every penny into the policy, but the insurance company won't let you do that. And there's some confusion because Nelson Nash said you should, your premium should equal income. Can you do that over time? Yes, over maybe a decade or even longer. But just thinking about starting your policy, you're going to be using about 20, 25, 30% of your gross income could be maximum premium. So we're just kind of setting those guidelines up. That's why human life value matters. That's why your income matters on your maximum amount of premium that you can put in your policy. All right. So the next thing we're going to go through are a couple policy designs, and I'm just going to put the brakes on here just for a minute because I really, really want to stress a point. When you get a policy design for infinite banking, the design must support the problem that you're trying to solve. So if you came to us and you said, hey, I've got an estate planning thing I'm trying to do where I need legacy, I'm building up death benefit, that would be a completely different design than we would do for someone who's trying to be, running money through a policy for a real estate investment where they want to get a big chunk of money in, get a big chunk of money out, and go to work. So our team is laser focused on this aspect. We want to make sure that we understand the problem that you're trying to solve so that the design can work together. And I'll just tell you, there's a lot of folks out there that do the wrong policy design. How do you know when you have a wrong policy design? Well, it's going to fit kind of like this kid's suit. The coat's going to be too big. The shoes aren't going to fit. You're probably going to try to run. You're going to trip and fall. You're going to try to reach for something. You can't get your hand out of the coat. So I'm just going to stress here that you really, really want to get the policy design in line with what you're trying to do. So anyway, I get frustrated with this. Others get frustrated with it. But there's some rubber stamping that goes on out there where everybody gets the same suit. If you're a kid, you get this size suit. If you're a 250-pound man, you get the same suit. So anyway, I just want to bring that to the forefront that it really, really depends on what your specific situation is. So I've listed out some design considerations, and if you were trying to build an infinite banking system, we're going to be looking at what is your human life value. We're going to make sure that we're not asking for something that the insurance company wouldn't approve. We're going to be looking at your income to premium ratios because, again, we don't want to go in and build a policy that the insurance company wouldn't approve. There's some unknowns with just the underwriting process because we don't know everything about your health, but typically looking at age and health and lifestyle, all of those things are going to take some consideration of design. And one of the important things we definitely want to figure out is, are you trying to pay down debts? And I'm just curious for everyone that's with us today, do you by chance have credit card debts? Do you have car loans? Do you have personal loans? Do you have student loans? Are there people out there with us today that have some debts that would make sense to talk about, and maybe we could build a plan around helping you efficiently pay those down? So it looks like we have a bunch. So we're going to go through a use case, and I'll show you at a high level, kind of what that could look for you. And then we may have some folks out there looking to build an opportunity fund, or maybe someone that wants to get ready to make a major financial purchase where they want to finance it, such as a car, college for their children. And so those are some of the different solution sets that we would want to hear from you, and then we'll dig in and kind of help build a solution around that. So I see home renovations, legacy, car purchases. So all of those kind of fall into that solution set that is going to drive how we're going to build that policy. And then we might want to know more about the loan utilization that you would want to do. So for those people that said, hey, I want to build a policy to purchase a car or to do a home renovation. Well, how much do you need and when do you need to buy? Because if you tell me you need 50,000, you're trying to run that money through the policy and we're only putting in 500, well, that's not going to work. That's going to look like that kid's suit that I just showed you. So there's also some considerations of dump ins. And for those of you that are new, you may not have heard of this term dump in, and you may even been told by others that you can't do a dump into a whole life policy. But we're here to tell you that you can because we do it all the time. Stephen, can you take $100,000 and dump it into a policy from day one and then put in an ongoing premium of say 15,000?
Yes, typically, absolutely.
And so why would someone do that? I mean, it's kind of like, what do you, I know you do a lot with real estate, but why do people do that?
Yeah, I mean, everybody has a different financial situation, but at the end of the day, we all know what we can typically save annually or what we're able to put into something like this, depending on how we're using it. So let's just say that I'm comfortable putting $20,000 a year into a policy to start building my banking system. But, I just cashed out of some real estate deals. I have some money sitting in a savings account and sitting in some business accounts that's, I'm going to put into another investment. I just am not sure exactly what yet. So instead of, my options are to let that remain sitting in a bank account where it's not really earning for me, maybe, a couple percentage points in a savings account, something like that. And, when I do use the money in a new investment, that money's now into that. Or my other option would be to dump it up front into the whole life policy because remember all the money that we're putting into this whole life policy, that cash value is going to grow and compound guaranteed uninterrupted for the rest of our lives. So even when I get to the point of where I'm ready to put it into the next investment, it's still now in that policy growing and compounding for me, even while simultaneously I'm using it in the new place. And on top of that, it's growing at typically a better pace and a better rate than it would have otherwise just sitting in somebody else's bank account. So it's a huge advantage to get that money dumped in there. It also really increases that cash value up front right away. So I'll be able to borrow out a lot more right away within 30 days by doing a dump in like that.
Yeah, and those are great points. And one of the things that folks will do with dump ins is, in the case that Stephen was sharing with us, where maybe you sold a piece of real estate, you want to run the money through the policy. That dump in is about 90% accessible within the first 30 days. So if you dump in 100,000, you'll have access to around 90,000 of that within the first 30 days. So it's highly liquid. Just like Stephen mentioned, it really juices the cash value right away. So there's a lot of benefits to doing that, but that's all part of the design. Maybe a dump in isn't something you're going to do or even make sense for you, but we just want to lay that out there. And then there's some considerations on what we call the MEC prevention, which is stands for Modified Endowment Contract. That's where if the policy doesn't meet certain criteria, it could be taxable. All of our policy designs are designed to be, tax free. They are not MECs, but it's something that we have to balance out with the cost of term and dump ins and all these things. So a lot of this, that's what we are experts in. I'm just simply sharing this with you so you know some of the terminology. But after we understand your solution, then we can kind of build around and take all these ingredients. Just like the 2 weeks ago, we had the cooking show. It's all those ingredients on how to build a policy and how to build a really good policy that works specifically for you. The last thing I'll mention, there's more, but the last thing I want to mention is really this balancing act between the base portion of a premium and what we call paid up additions. Now, if you've looked at a traditionally designed whole life policy where it's just an off the shelf whole life policy, 100% of the premium goes to buy death benefit. There's no cash value for the first 2, 3, years. And then even by that, you might have put in 50,000 and you have 2,000 of cash value. That would be
And just let me hit on that. Like,
Yep.
just so you all know, because I know sometimes we hear only what we want to hear. Like, can you just imagine, like, you're putting money into a policy and you put 50 grand in over 3 years, hypothetically, and you hardly have any money in the third year. Like, that wouldn't be a good scenario. That's what Dave Ramsey's always talking about. That's why he's always saying, oh, whole life is the worst place you can put your money. Like, the only one who wins is the insurance company and the agent getting the big commission. And that's the biggest difference. Like, again, to preface what we're going to show you, like, it's specially designed. So you get immediate cash value usage immediately in the first 30 days, the way we design them. But the average person on the street, the average agent, financial advisor, or any of them, they're selling you a product that has no cash value in the beginning. And if any of you get led down the terrible pathway of indexed universal life, commonly known as IULs, same thing with them. But those are even worse because they have surrender charges. So they'll tell you that you have cash value, but then you'll find out you can only use the surrender value, which is significantly less. So just be very careful. You know, when we're talking about this stuff, it takes somebody who understands how to specially design and engineer these contracts to do what we're about to show you. This is not just an off-the-shelf thing that your broke-ass brother-in-law or financial advisor would easily be able to figure out. They'd have to know how to build it within the guidelines and everything to make this work. And most simply do not. We see it all the time.
Yep. Absolutely. And one of the things, I think it was 2 weeks ago when we did the cooking show, we presented a number. We did some number crunching just of how our policies are designed. Now, when you have a base only policy or a traditionally designed whole life policy, as Chris mentioned, commissions are high for those insurance agents. Once you start minimizing that base premium and maximizing the paid up additions, which gives you the cash value early, those commissions get squished. And so in the whole context of giving up something to get something in the longer term, you do that when you start this process, but we also do that up to the tune of about, what we come up, I think it was around 72%, Chris, of what we gave up in commissions last year. So it's one of those things where when you do infinite banking and you build a policy for infinite banking, you can't go in there with a traditionally designed policy because it's not going to work. You can't put in $50,000 in 3 years and use $3,000. It's just not going to work that well. But if you have, I will put a little asterisk here just for anyone on the call that may have a whole life policy that you started 15, 20 years ago. Please do not throw it away. It's probably at the point where it's efficient. You can probably use that, but that's something our team could help look at and give you some guidance on. So don't take what I'm saying and go, well, I have a traditionally designed whole life policy, I need to get rid of it. Perhaps you don't, because if it's matured, like the bamboo tree has grown, you can probably still use it. So let's just have a conversation about that, and then we can help you through it.
Breaking news, this just in. Are you sick of having your money lying around not doing anything? Well, we've got the solution for you. PrivateMoneyClub.com. Back to you, Chris.
All right, so we're going to go over two different design considerations. We're not going to dive deep into the numbers. If you want to see this for your own particular design, we can do that. And so what we're typically doing with these designs, I'm going to say, okay, I've got a person that maybe has a debt situation, or I've got a person that has, let's say they're doing real estate. So in this case, if I've got someone that has a bunch of debt, maybe they were saving $1,000 a month, maybe they were putting some into 401k and they decided to go only to the match and free up some cash. Whatever your situation is, let's just assume that you're putting in $1,000 a month or $12,000 a year. This is what a policy would look like at different points in time: year 5, year 10, year 15, year 20, all the way to year 30. And so what's happening is in the policies, you'll see these green columns. Those are your guarantees. And Chris mentioned it at the beginning of this. A lot of people can't say the G word, the guarantee word, because the products don't have guarantees in them. Whole life insurance, they have guarantees. And where those become applicable is if the mutual insurance company does not pay the dividend, they are still going to guarantee you growth at a certain, could be 2%, could be 3%, some are a little higher. Now, the question would be, and I'm going to pose a question out to the audience, of the major mutual insurance companies, how many of them have missed paying dividends in the last 100 years? What do you think? Linus thinks none. Drew thinks zero. Anybody? I mean, maybe there's a few that have missed a few years. I mean, come on, we went through the Great Depression, bank holiday of 1933. Do you think remember the bank holiday of 1933? There was a run on the banks. Banks are shutting down because they just don't have the money. There were some bad times. We had World War I, World War II. Well, I know a lot of you that said no, you know the answer. And of course, they've always paid dividends for well over 100 years, some of them over 150 years. So let's just stop for a minute. Doesn't that just blow you away that Great Depression, bank holiday, world wars, and mutual insurance companies are paying dividends? Banks are failing. It's pretty wild. And yes, Shane, I did say major, but let's just say any mutual insurance company that's been around for 100 years.
None of them have ever missed the dividend payment, just for the record, not one.
Yeah. So why did I go through that whole rant? Well, it's because it's really nice to have the guarantees in the contract, and we love the guarantees. But when the insurance companies pay the dividends, the ball game is different because you'll see everything in the blue section in these numbers represents the insurance company paying dividends. Now, can the dividends go up and down throughout time? Yes, and they have. You can go out and Google any insurance company. For the most part, they post their historical dividends. But with the dividends, this is what your policy would look like. So one of the things I like to look at is what is the cumulative break even of the policy, which means if I've been putting in premiums, at what point does the cash value either equal or exceed the premiums? Now, in a traditionally designed whole life policy, let's say I go just down the street to to an insurance broker and say, hey, I want one of those whole life policies. If it's a 100% base policy, it may not break even until year 15, maybe year 20. So that takes a long time to break even. In a specially designed policy, the way we do them, it's, could be anywhere from year 4, 5, 6, 7, or 8. This specific one breaks even in between years 6 and 7. So that means by year 6, call it 6.5, I now have a cash value greater than all of the premiums I put into the policy, and from that point on, it's gravy.
Let me just put that in another way. When we show these, so the cumulative break even, when you're looking at these numbers, I want to just quantify what they mean. Cumulative break even means that's the point when you got all the money back that you put in for the policy. Now, a lot of people look at that and they're like 6 to 7 years. It's a long time, but yet those are the same people that are out there buying term insurance. And just so you know, when you buy term insurance, you never get any of the money back. So in this case, your cumulative break even means between year 6 and 7, so let's call 6.5 years, you've gotten all your money back that you've put in, but you still have a death benefit. So by year 6, let's just use year 5, you have $238,661 in death benefit. Bought and paid for, you've got all the money back if you wanted it. Now, what happens from that point is every year that goes on from that point forward, you can never go any other way but up. So you will never put more money in than you could take out. So it just keeps climbing, climbing, climbing. And when you look at IRR, and we never really use this, which is interesting that Craig put this on this sheet, internal rate of return at year 20. That's an industry term widely used in life insurance, IRR. We never use this metric, ever, because it does not apply to what we teach with the infinite banking concept, nor does cumulative break even. Doesn't make a difference, because those two metrics are if you put money into a policy and you never use the money. You just put it in the policy and you use the money. This is what every financial advisor will fight against. I'm dealing with one right now, and he sent this client a whole list of why they shouldn't put money in whole life. Oh, it doesn't keep up with inflation. The returns are too low. The fees are too high. Blah, 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 blah. All of it made perfect sense if he was talking about if what we were teaching or talking to this client about was putting money in the whole life and never using it. If you did that, you just put the money in this whole life, you just let it grow. You got all your money back in 6.5 years, and over 20 years, you made 3.64% on your money. That was your IRR. That was your average amount you made every single year on your money in the policy, and you got a death benefit. And by the 20th year, you got $330,000. So just let that sink in. Even in the world of today, that's not too bad. No bank account would ever pay you 3.64 average over 20 years ever. The return on a high yield savings is like under 1% over any period of time you look at. Number two, like you'd never have a death benefit with any other vehicle. Okay. You couldn't put your money in a guaranteed account, let it grow, get 3.64 tax, and that's tax free, folks. So the tax equivalent yield of a taxed investment would be probably 4+%, which you're not going to get on a guaranteed basis. But also now you got the death benefit. And remember, the death benefit is bought and paid for after 6.5 years. So when you're thinking about this, I want you to let that sink in. But you see, we're never talking to people about putting money in the whole life and just leaving it sit there. You literally would not be following us if that's what we taught. We taught putting the money in the policy and then finding somewhere for it to go make money a second time. This is what the advisors will never understand. They will never, ever get this. It's not this or that. It's not put your money in the whole life or go invest in real estate. Put your money in whole life or invest in the S&P 500. Put your money in the whole life or invest in Bitcoin. That's what they want to do. They are perpetually in this competitive thing where they got to compare. It is put your money in the whole life and put your money in real estate. Put your money in the whole life and invest in the S&P. Put your money in the whole life and invest in Bitcoin. This and that. Let that sink in. Because if that sinks in, all these returns you're looking at here, none of them matter except for the money tree. Craig, I'll let you continue with that.
Yes, and I'll get to the IRR and why it's in here. Sean and I were talking about it, and I knew you'd look at that and go, "What in the world is Craig doing?" But
I'm glad you did, because we never talked. I don't know
Yeah.
if we've ever even brought up IRR, but if we're ever in a competitive situation with a life insurance agent or a financial advisor, that's the only number they're going to know to use, because it's the only number they've been fed and conditioned to understand about whole life is IRR. And even in that case, I'm arguing that 3.64% is not a bad return when you get a fully paid up death benefit of $330,000. That's not bad, but that is nothing that we talk about or teach.
Yep. Absolutely. Now the money tree, and it works well with the parable we shared earlier, the parable of the bamboo. Remember when the bamboo broke through the ground and then it just took off? That's what the money tree is. What we're measuring there is if you're putting in $12,000 of premium, let's say at year 4, I put in, or let's just use year 5 because that's what I've got on the screen. At year 5, if we put in $12,000 of premium, and it's because of all the previous years compounding, we now have a growth of $13,010. Doesn't that mean that I get $1.08 out for every dollar I put in? So this actually happened at year 4. At year 4, we put in $1, we get $1.02 back. So now the bamboo broke through the ground, and you can just see over time by year 10, $2.63. Year 15, $3.31. 411, 528, 646. Our
Just preface
bamboo
that
tree
again,
is
Craig.
growing.
You said that fast because you understand, but I think a lot of people miss that. I put $1 into this stupid whole life, and in the 10th year, I take $2.63 out. 15th year, I put $1 in and I take $3.31 per dollar I put in. I put $1 in, I get $3.31 back. Please tell me who doesn't want to put $1 in and take $3.31 back, or $4.11 back, or $5.28. You see, it just gets better over time. Remember, a bamboo tree grows, what did I say, 3 to 5 feet a year? This is the bamboo growing, but it took time to get to this point. But now, let this sink in, folks. Craig, can I just take this one more place?
Yeah, please.
We're going to show this at the end, so stick around. Now imagine that's your returns, okay? But now you take all the money out of the policy and you put it into some investment that you know, like, and understand. Now, let's just say that investment makes 10%. But you're making, for every dollar you put in, you're making $3.31. Technically, that's a 331% cash on cash return, but whatever. You put $1 in, you took $3.31 out. You took the $3.31, you invested it in something else. Are you ahead of the game? Yes. And if that thing you invested in makes you 10%, how much did you actually make? 10 plus the compounding that you earned in the policy. It's not this or that. It's this policy return and the return of whatever you invest in. The only differential in between, which we'll show in a sec, is the cost of the loan from the insurance company. And this is what other advisors always say, oh, yeah. They say you can take the money out, but they didn't tell you what the cost was. Yeah, cost right now is about 5.25%. Yep, you can take your money out for 5.25%. Simple interest. And the insurance company will never ask for the money back, and they only charge you interest one time a year. It's calculated daily, but they only charge it once a year. But hold on a second. Go to year 10. I put $1 in, and I was able to take $2.63 out. That equivalates to a cash on cash return. Correct me if I'm wrong, Craig, but that's 263% cash on cash, right?
Yep.
But it cost me 5%. I don't want to do that. Think about it. I made 263% that year on my money. It cost me 5% to use it. And 5% is the number, 5.25%, the loan interest rate is the number people are going to hang up on. Let that sink in, because it doesn't make any logical sense. Even in the 5th year, I put $1 in, I take $1.08 out. That's 8.42% I made on my dollars that I put in that year. That 12,000 I put in, I made 8.42%. I take that money out, it cost me 5. How much did I make? The spread between 8.42 and the 5.25. 8.42 minus 5.25. I made that. That's my gravy, my net, my spread. And then you make money on whatever you invest in or whatever you use the money for. You make money twice on every dollar. The money tree, as we call it, right here, it took you 4 years to hit that point because you didn't do a dump in. You gave up 4 years of gains. Just like that, it's almost identical to the bamboo. It took 5 years for the bamboo to sprout its roots so that it could sprout and shoot up into the sky. It took you 4 years to hit that point where your policy had enough cumulative return, not cumulative, compounding growth to shoot up to the moon. And then from there, it's just off we go. I don't know a single person, once they understand that, they would ever question why they would give up for 4 years to get for the rest of their life. Unless maybe, Craig, they've only got a couple years to live. Well, Chris, you know what? I'm going to die in 2 years, so this doesn't make any sense. Really, how do you know you're going to die? Oh, the doctor told me. I said, I would just tell them, go out and start eating some dandelions out in your front lawn. You'll probably do a lot better off. Anyway, not going to play doctor today, but you get the point.
I hear dandelions are good for you, but I've never eaten one. But I do see some comments coming through, and I think this is a really, really, really good point for people to walk away with, because I don't know, even though you just went through it, I don't think people are hearing. This is the policy and it's growing. This is just the policy growth. That IRR is just the policy. But Chris mentioned, we don't tell you just to fund the policy and let it sit there. So guess what? I've had people in the past tell me, I'm a professional poker player, and I can make way more money with my money than just putting in a policy. I'm seeing some people saying, hey, I'm a day trader. I can make way more money than this. Guess what? This is not an investment. And the IRR thing bothers me just because we're treating it as an investment, but it's not an investment. Here's the thing. Let's say I'm the best poker player in the world. Wouldn't it still make sense for me to put my money in here, take my money out, go do my poker game? I made a gain, put it back in here. Now I've got money growing in 2 places. I've got the death benefit. Couldn't I put the money in here and do day trading? Can I put the money in here and do real estate? Can I put the money in here and go do, a stock fund? Whatever like, and understand. What we're trying to teach here is this is the place where you're going to store your money before you go do something else with it. And as Chris just shared, take that 3.64 IRR and add that to what you're doing with the money in addition to the policy.
Real quick, Craig, there's a whole bunch of people asking how they can talk to one of us about this and look at their individual needs. Some folks earlier were saying, I have an old policy. Could you guys review it for us? So folks, we're going to put up a link right now so you can book a call with us. The call is not a sales call. I want to be clear about that. It's a call where we get to know your needs and goals. We get to talk about your situation, and then we can build a solution to whatever problem it is or whatever it is you're trying to do. So if you want to do that, there's the link right there. Steven just threw it in the chat. So just click that link, pick whatever time is convenient for you, book a call, and we'll dive into your individual situation. Today, we're going into this stuff. We haven't even got to the good stuff, but I saw it, Craig, I saw it in the chat when people connected the dots and they said, wait a second, it's not this or that, it's this and that. And then some people are like, it's this and that, and this is tax-free. Wait a second. Wait, it's this and that, and it's tax-free, and to use the money, it's simple interest, not amortized interest? Okay, they're getting it. So folks, if you want to book a call, there it is. All right, let's keep going.
All right, so let's move on. The last thing I'm going to mention just on this is I hear a lot of times people say, well, I keep putting money in, but my death benefit doesn't go up, because they're thinking about a traditionally designed whole life policy. You can see in this last column where it says projected death benefit, it keeps going up, right? There's a little dip, and we can get into the details about that. But generally speaking, this is going to continue going up as your cash value goes up, your death benefit's going up. So It's this whole tool and this specially designed whole life policy is going to behave completely different than what you've been told about whole life. And so these are just some of the highlights we wanted to hit on. Now, let's talk about a dump in policy. And then we're going to use these for some different purposes. Here's
Okay,
that
Craig, make
same.
sure they know what a dump-in is, though, because I mean, we know that, but I don't think some people are like dumping, dumping. Did I sit on the toilet? And yeah, anyway, you get
Yeah,
what I'm.
well, we'll skip that piece of it. But earlier, Stephen was kind of sharing why someone would do a dump in, and essentially what that is it's kind of a bulk funding. So let's just say I had a $250,000 dump in. I'm going to put that in year one, and then I'm going to do a premium that goes along with that. In this case, it's $26,000. Now your dump in might be 100,000, might be 50. The dump in and the premium kind of need to work together, but if you have cash laying around in a savings account, that's oftentimes money that we would say, hey, let's do a dump in. Or if you just sold a piece of real estate, you're a real estate investor and you've got, some proceeds from that, that could go into the policy. And then you could pull out about 90% of that within the first 30 days of your policy being active. So the dump in is a way to supercharge the policy, get a lot of cash in there, get a lot of access to cash. It drives the cash value really high. So if there's any questions on dump ins, go ahead and put them in the Q&A, but hopefully that clears up a little bit about what a dump in is.
It's an interesting thing too, Craig, with the dump-ins, because a lot of our clients, when we talk to them, most of them do a dump-in, and it's a big shift. We've seen this, and that means a lot of people just have lost faith in keeping money in banks, lost faith in the returns they're getting. They were getting good returns, and the bank has reduced them. So the dump-in literally just gives people a better way to dump the money in. But the other day, something hit me, and I've never talked about this in any webinar. I just want to bring it up right now. Let's say somebody did this and they dumped the money, and that gives them in the 5th year 3.5 million. Now I know, we're not building these for a death benefit, but I have a client who's got they have cancer. It's a rare form of cancer, and they had called and they had just said, hey, listen, we don't need this now, but if push comes to shove and things worsen and I can't afford the medical care and everything else, I had heard somewhere that I can use some of the death benefit to pay for my care while I'm living. That is absolutely true. These are called living benefits. So we're talking about cash value, which is a living benefit. But look at that death benefit. Okay, 3.5 million in the 5th year, and yes, it drops because we dropped the term rider. But let's just say it was $1 million. Let's say you came down with cancer and you needed money for whatever, your care. There's what's called a critical illness rider and a chronic illness rider. There's 2 riders that come on every policy we do. We don't ever talk about them. That should you ever come down with any of one of those, then there's a bunch of them, a stroke, cancer, I'm not going to remember them all. You can have access to some or almost all of your death benefit while you're living to pay for the care. And then the chronic is if you can't do 2 of the 5 activities of daily living. They allow you to access your death benefit to fund some of that care. So folks, it's not just about the cash value, but these riders, it's the first time I've ever had somebody ask me about it, but these riders are very important that give you access to not just the cash value, but also more of the death benefit while you're living, if, God forbid, you ever needed that.
Yeah. So there's a lot of side benefits that come along for the ride, even though we're focused a lot on the cash value. Now with this policy design, you're going to see some bigger numbers because there's a $250,000 dump in or one-time funding in year one. And then the person is putting in $26,000 of annual premium every year. So what did that do? Well, it drove the cash value higher. It means our cumulative break even in the previous example is between year 6 and 7. Now it's between year 4 and 5, which again, we'll just reiterate, cumulative break even is I've got all the money back that I put into the policy in cash value. So at that point, it's just taking money from one pocket and putting it in the other pocket. It's still yours to use and leverage. And the other thing that happened, which that money tree or that bamboo shoot, it popped out at the end of year 2. So we didn't water it for 5 years. We watered it for a couple years. And now for every dollar you put into the policy, by the end of year 2, you're getting $1.12 back. So it drove the efficiency up earlier by doing the dump in and configuring it the way we configured it here. So just to kind of show you the different numbers, you can see if you look at the projected cash on cash going down the road here, by year 5, it's $1.34. For every dollar you put in, you're getting $1.34 back. Year 15, every dollar you put in, you're getting $2.72 back. So everything just got bigger and the efficiency was driven higher. And so that's just another design. And I may design a policy this way for someone who's trying to get money into the policy, pull it back out to do the next real estate deal. Okay. Any questions on this or anything you want to add to that, Chris?
No, sir.
All right, let's move on. We did touch on some of the living benefits that Chris talked about with the chronic illness, the terminal illness. Those are really important. God forbid anyone needs them. But a lot of times we don't talk about the death benefit. So I do want to just bring that up and think about what the death benefit's doing while you're building this system, while you're paying off debt, while you're leveraging this cash value to build more wealth. You also have protection for your family. So if you get hit by a bus, something happens to you, you now have some protection in terms of that death benefit that's going to help protect some of the, the income to your family. The other thing we can look at is death benefit is a built-in wealth transfer strategy. So when you have a death benefit, that's going to your named beneficiaries tax-free, right? So now you're transferring a large amount of money to your next level. It could be your kids, could be spouse, whomever, but that's going to go in terms of a tax-free transfer. And just pulling a quote out of something Shauna shares with us a lot, from Garrett Gunderson, it says, buy your net worth now instead of hoping to build it. So how do you buy your net worth now? And what's described in this process is you start with a whole life policy, and we want to use a specially designed whole life policy that has death benefit. The death benefit's guaranteed, so your family's protected. Now, when the market's going up, market's crashing, tariffs, whatever's going on in the economy, that doesn't change the fact that you have this policy that's growing with guarantees and death benefit. So you don't have to worry about that piece of it. And while all that's happening, you have the bamboo tree growing. Your cash value continues to grow. You continue to build and build and build. So when we talk about death benefit, those are some really important points. Now, before we go on to the two use cases, I'm just kind of curious, and we've talked a little bit about this, but if you had a policy set up, what would you do with your first policy loan? I listed some things out here that are pretty common, but I want to hear from the audience today. What would you do with your cash value if you had a policy and you could access it within the first 30 days? Got some debt pay off debt, start a business. And I love the real estate portion too, because a lot of times with real estate, people might say, well, I need it, 200,000, I need 500,000 to get this real estate deal. But what if you looked at starting small and just saying, I'm going to use my policy for the rehab, or I'm going to use my policy for the down payment. So there's a lot of different ways you could do it. Looks like someone, Mr. Diamond, going to invest in the television network. So many cool things. And I think Nelson Nash appropriately named this the infinite banking concept, because if you can think about different strategies, there's an infinite amount of ways to use your policy. We listed some of the common ones here, but I love just how everyone's kind of chiming in with all the different
I
ways.
like what Chase said there. He said, pay off my debt and then invest in real estate with a down payment for short-term rental. I like the fact that he said, pay off my debt first. A lot of people, they've got debt, but then they're out there trying to buy risk assets, stocks, real estate, or anything else while they maintain all the debt. And that's usually backwards. I get it. Debt can be good. Debt can be leveraged. Debt can be a tool, but bad debt will never be good for you, and you'll never get ahead until you erase the debt. And when you erase the debt using this system, the infinite banking concept, you recycle and recapture all of the money you were paying to the debtors. Remember, the banking function is greater in your lifetime than the need for death benefits. So that's the banking function, taking back all the money you're giving away. That's always the way you do this, folks. So, I love the creativity and everything in what everybody said, but if any of you have debt, debt's first. 100% of the time. Now, yes, we can define debt different ways, but let's say high interest debt, credit cards, car loans, things like that. Pay them off, which is why Craig's got the first use case being debt. I got ahead of myself, Craig. Sorry.
It's okay. So we're going to do some debt blasting. And for those of the kids of the 80s or the people that love the 80s movies, we've got our famous Ghostbusters Don't Cross the Streams. But we're going to show you how to blast away your debt. Now, I'm going to use that policy that I shared with you which is the 12,000 annual policy example. So that's what's going to be driving, essentially driving the use case here. So if you have debts and you want to book a call with our team, what I would suggest you do is get your debts organized. And what I mean by that is make sure you've listed them all out, list the remaining balance that you have, your interest rates, and your payments. And then when you come to meet with our team, that's the first step of getting things organized and helping you determine what can we run through a policy, how long is it going to take to pay off your debts. The other thing I would mention too, there's a lot of folks that have these 0% introductory cards, which are great because you're paying 0%. However, there's a timer on them. And we want to know also, when does that introductory period end and what does that interest rate go to? So that's all something we have to factor into the plan here. But down below, I mentioned we're going to show you 3 ways to pay off debt. The first one is kind of, don't do anything differently than you are now. You just pay off a debt. Let's say I pay off my Discover card here and I was paying $161 a month. Well, what am I going to do with that 161? Well, I'm going to go spend it. I'm going to go out to eat more often. I'm going to go buy some more stuff. That's what option 1 is, which is we're just going to kind of pay off each debt in a singular fashion. When that debt payment's done, we're just going to go blow the money. Option 2, when we pay off debts, we can use a strategy such as snowball, which is lowest balance to highest balance. We could use avalanche, which is highest interest rate to lowest interest rate. We could use the cash flow index, which is basically a ratio of the balance to the payment. And those different strategies, you'll hear different folks out in the world on social media always do snowball or always do avalanche or always do cash flow index. And here at the BYOB team, we don't care which one you use, but we want to tell you which one is the most efficient. So the snowball could be more efficient for you, or the avalanche could be more efficient for you, or the cash flow index could be more efficient for you. We're just going to map it out and tell you which one is the most efficient.
Craig, we got something really exciting that we've been working on for a while. When is that we're going to be able to start talking about that to everybody?
Well, I was playing with it, working on it some more this morning and with the developer, and I said, hey, when can we start rolling some of this stuff out? And I think for some of the debt stuff, we're probably about a month, worst case, month and a half out.
So
But
mark
it's
your
going to be
calendars,
so
folks.
cool.
In about a month, we have something wild to show you. So if you like what you're about to see with this debt blaster, we have something that escalates this to the moon.
To the moon. And so what we're doing here is just kind of mapping out the debts, showing a couple of different options. Option 3 is where we're going to use the cash value in the infinite banking system and add it on top of option 2. So if you're doing the snowball, we're going to accelerate that snowball. If we're using the avalanche, we're going to accelerate that. So that's what option 3 is about. We're not going to go into great detail on the debt strategy. There's already videos out there. We've done these many, many times, but I just wanted to show you the outcome. So remember option 1, it was where you pay off a debt. You take the payment that you were paying to that debt and you go blow it. You go buy more stuff. You go out to eat more often. With this particular set of debts, it would take about 75 months to pay them all off. You would make $173,000 of payments, and of that, $35,659 would be interest. And usually when people see this, they say, well, is there a better way? Because I don't want to pay these debts off for 75 more months, and I certainly don't want to pay $35,000 of interest out to the banks. So now if we say, all right, if you're disciplined enough to do a snowball or an avalanche or a cash flow index, whichever one is the most efficient, we call that a sequencing method. What would happen is you would take that first debt, that 161 that was the Discover card, when that's paid off, you would add that to the next debt. And then when that debt's paid off, you take those 2 payments and just keep stacking them on to the next debt payment. We're now going to cut our time down to 45 months. We're going to cut our total interest down from 35,000 to 26,000. So I would say most people are going to pick option 2 if they look at option 1 versus option 2, because you're paying less interest out to the banks and you're getting it done faster. Now, what if we run our savings through an infinite banking system? We build a policy, we run our savings through it. While it's compounding and growing uninterrupted, we leverage that and take out the maximum cash value and throw it at the debt the debt that we're working on. If we do that, we're now going to get rid of all of our third-party debts in 35 months, and remember, we're using that 12,000 annual policy that I showed you earlier. You might be doing $500 a month. You might be doing 15,000 a year. That's where it's going to be dependent on your numbers and your specific design. But just stick with me. We're using a 12,000 annual policy. If we use that maximum cash to throw at the debts, we're now going to pay off all those third-party debts in 35 months. Okay, so if I go back here, what this means is Discover card's gone, Wells Fargo card is gone, Lowe's is gone, our private loan's gone, our West Marine boat loan's gone, our BMW's paid off, our Nordstrom dress or whatever we bought for 9,781 is now paid off. $137,424 of debt is gone. We don't owe any of those companies that money anymore. However, what we did is we shifted some of those debts into the policy because we were taking policy loans. So for the next 9 months, we're going to pay that same amount. Remember, we were paying $3,677 out to Discover and Wells Fargo and Lowe's and everybody else. We're going to be an honest banker and we're going to pay that same amount of $3,677 back to the policy loan for 9 months. So now what this means is we've spent 44 months paying off the third-party debts and restoring our policy. And so we have all of our cash value paid back. In 44 months, we're done with this debt cycle. And I don't remember who said it, but they said their approach would be to pay off their debts, then take the cash value. So in this case, we now have 40,000 of cash value. And guess what? We can go build wealth with that. We can invest that in something we know, like, and understand. But one of the things I get excited about is if you do debts in option 1, you're paying 35,000 of interest. If you do debts option 2, you're paying $26,000 of interest. And if you do option 3, you're paying $17,000 of interest.
But you got 40,000 in cash value to use plus a death benefit of 213. Dave Ramsey, like, eat your heart out, because Dave Ramsey's number 2, if you haven't figured that out. And number 3, you just add this specially designed whole life to the mix and follow this process, and that's what you get. Like, that's the part where, like, option 1 and option 2 make absolutely no sense when you see option 3, and it's all the same thing.
So you not only have the 40,000 to build wealth with, but guess what else you have? The $3,677 that was going to debt payment is now free cash flow. So maybe it's now time to get a policy going on your spouse. Maybe it's time to get policies for your children. So you're now in a different level. You've got that debt out of your life. You can start to build wealth. Now, trivia time. What does option 1 and option 2 have in common? Remember, option 1 was we're just going to pay off a debt, blow our money. Option 2 is we're going to use a snowball Dave Ramsey kind of approach. Option 1 and option 2, let's go back and take a quick look at them. If I spend 75 months paying off my debt, $173,000 gone. If I do option 2 in 45 months, $163,000 is gone. I still have some of my money gone in option 3, but option 1 and option 2, eventually your debts are gone and so is all your money. In option 3, we're able to capture some of it. So would you rather have all your money going out the door, or would you rather keep some of it? And that's really the decision you have to make. Are you willing to give something up now so that you can retain and keep some of that money? Or do you want to just give it all away to the banks? I'm sure Discover would love to hear option 1 or option 2 from you. All right, cash flow creator. Now, what we're going to do is we're going to use that bigger policy with the 250,000 dump and the 26 annual policy or annual premium to build more income. Going to take a quick side road here. There's another element to this, which is called the private money club. The private money club, and I love the way Chris and Steven talk about this all the time, it's the dating site for money. It's essentially people that have projects that are looking for money, meeting with people who maybe they're infinite banking people and they have an opportunity fund in their whole life policy and they want to be able to deploy that money to do that and step. Remember that IRR we showed you? It might be 3 point something, but now we want to take that money, put it into a deal where we're going to make 15%. So our IRR is going to go up. Our wealth building ability is going to increase. Our bamboo tree is going to get bigger. So on the private money club, should you decide that's something you want to get into in terms of something you know, like, and understand, this is a deal I pulled right off of the private money club. This person is looking for $145,000 to do a 15% rehab. They'll put you in a first lien position. So what this means is if I did this deal, I took $145,000 out of my policy, lent it to this fella, and he's going to pay me $1,812.50 every month until that project's done. So now I'm making money here, and my policy is still growing on uninterrupted compound interest. There's a cost of use of that money, but that's what I'm going to show you next. We're not going to get into the great details of every year of how the money flows, but think of it this way. We're putting our premium deposits or our savings into the specially designed whole life policy. So that 250,000 dump and that 26,000 a year is going into the policy as premiums. Within the first 90 days, we can take a loan out and put it into a segregated account. It's just simply a different account from our grocery bills and gas bills and our taxes and whatever else we're doing. But essentially, we're taking a loan from the insurance company, putting it into our bank account, and then we're deploying it into an investment. Now, I've got Private Money Club here, but you might be a day trader. You might be, someone doing Turo. It doesn't matter what's in this box. This is your investment that you know, like, and understand. Our plan is to get that investment to create gains that come back into your segregated account. And from there, you might take a little bit of that and pay off your loan interest, and the rest of it might go back to work. So there's a lot of different ways the money can flow, but this is generally speaking how most of us that are using our policies for wealth building use it. Take loans, deploy it, bring the gains back, and put it into our policies. So if I were to do a 15% investment, and I'm going to just take that 100 and whatever it was, I'm going to deploy that, and I'm going to just keep my money going. What we're going to be looking at is different samples of years. So by end of year 2, I put $302,000 into my system. That's premiums that I put into my system. My net benefit consists of any of the remaining cash value in my policy plus my investment. So I've got the money out there deployed plus my gains. So if I were to use the policy money and just put that into a 15% deal, by the end of year 2, I've got $336,000 net benefit. I've got a $3 million death benefit. My cumulative return at the end of year 2 is 11.197. Now, is that a little bit better than the IRR in 20 years of 3%? Can you see how we're taking the money and we're putting it to work making more money? So our IRR is going to be going up. This is a cumulative return, but our IRR is going to continue to go up. Let's say we keep doing this year over year over year. Year 7, we've put $432,000 into our policy. We now have a net benefit of $793,000 because that will be the money that we've deployed, put to work at 15%. Those are our gains. That's our remaining cash value we have in our policy. And we still have a death benefit of $3.2 million. Now my cumulative return is 83.274%. And I can just keep going. Let's just jump to year 15 for time's sake. We put in $602,000 into the system. We have a net benefit of $2.6 million. We have a death benefit remaining of about $570,000. So in 15 years, we have a cumulative return of 341%. So I'm just going to ask, the audience here, if you were able to build a system where you had a guaranteed product that's growing and has death benefit to protect your family, plus it has chronic illness riders and all those other things, and you could use it to build more wealth through an investment such as a private money club opportunity at 15%, why wouldn't you do it? I mean, who's in, right? Shane's in. See a lot of people that want to do it. This is what we do. This is what we teach. This is what we do day after day after day. And so let's just recap, because I know we're at the end of our time here. So what have we learned today? We learned that if we have long-term thinking, we can build wealth. We learned that if we give up a little bit of short-term liquidity, we'll have long-term leverage and control. And all of this, if we just remember the bamboo tree, we're going to water those bamboo roots, and then eventually it's going to pop out of the ground. We're going to have that money tree or that bamboo tree that's going to continue to create more money year over year than we put into it, and then we can leverage it. We have a death benefit that protects your family and builds a legacy. We have chronic illness riders. We have terminal illness riders. If God forbid something happens to you, you can tap into some of that death benefit, get some health, some home health care. And if you take anything away from this, people get so stuck on the rates, the interest rates for the policy loan, the guaranteed rates inside of the policy, the IRRs. It's not about the rates. It's about the control, the liquidity, and the leverage that you can use to build more wealth, to protect your family, to do all of those things. So with all of that said, if you want to see how this would specifically work for you, you can book a call with our team. I saw a lot of people that have debts. Come prepared. And what we mean by come prepared is have your debts, have your numbers. If you're an investor, tell us what you want to invest in. Tell us how you would want to use the money. And we'll work with you to kind of map out and build a policy that will help you achieve your goals. So we just need to work together to do all that.
The only thing I'll add is, there's a lot of folks on here that have been around this campfire for a while. They're already using the infinite banking concepts. They show up to all these webinars. But, not long ago, we relaunched something that we started back in 2020, and it's called MSTV, stands for moneyschool.tv. And it was kind of our version of TV Guide. Instead of tuning into TV like we did, we used to look through TV Guide for the favorite programming. I know today you just search, but I'm just trying to hit, some of us that remember TV Guide, and you pick your favorite thing to watch. Well, imagine that, but your TV Guide has all shows, all money. And I know Tess is doing a live training, and Tess has been on here. She's on every single week. She's doing a training this coming week on there. So if any of you want to watch Tess or any of our money mentors with these unique trainings that are not available to the public like this one was, you would just go to moneyschool.tv, and that's moneyschool.tv. I'll have Stephen put that in the chat, and you guys can sign up. It's a whopping $19 a month for this. It is subscription only, members only site. We put lots of different trainings in there, all sorts of stuff that you can't get out there. It's not on the YouTube channel. So this is kind of our private little community. So if any of you are interested, it's moneyschool.tv. That's $19 a month or $190 a year. And we'd love to see you on there, and I'll just put the link there if anyone's interested. That's all I got, folks. So with that being said, we got another webinar this afternoon, but this is a fun one. It's called Ask Me Anything. You come on, you ask your questions, no matter what they are, how wild they are. The whole team will be on there just to serve you and answer your questions. So join us at 4:30 in order to do that. Just go on one of my Facebook pages or specifically go on YouTube. Make sure you're subscribed and click that little bell up top so that you're notified when we go live. But that's how you do it. With that being said, thank you, Stephen, Craig, Shauna, and team. And thank you to every single one of you, 159 people over the bell. Thanks, and we'll see you really soon. All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.